Hello and welcome. You're with us here on Business Today, and joining me today, a very special guest, Balasubramanian. He's MD and CEO of Aditya Birla Sun Life AMC, as well as chairman of AMFI. And Bala has been, someone who we've been speaking to for many, many years, and look forward to having him today here on Business Today. Bala, first, let's get your all-important take on the markets. We saw a nosedive today. Is that just a reaction coming into the latest set of earnings? Where are we when we take a look at the overall trajectory? Because there's a lot of uncertainty and nervousness about whether or not a drastic fall is coming.
I think, first of all, thanks, Aabha, for having me part of the show today. Clearly, from a market point of view, I think we are just coming after the recent uncertainty that got created thanks to the Russia and Ukraine war, and which has led to the complete rise in the commodity prices globally. They also put a question mark in terms of how the growth is going to come back by way of global spending, which was likely to be the driver of the market earlier. And with this change in the dynamic, the geopolitical risk that has come, definitely I think the growth expectations have got moderated. But having seen inflation rising across the globe and Fed now having taken the first step of rising interest rates, I think now is becoming a phenomenon globally of interest rate cycle to begin. But that being the case, definitely from a market point of view, is not something I think you would get to see only the growth and the earnings growth. And then the market will be driven as a result of that. And this uncertainty definitely is now playing a role in the equity market. Having seen a significant rise in the last few years, last 2 years, we saw a significant rise in the equity market. Therefore, I would say the correction is actually the function of that valuation getting corrected, and the earning expectations are getting moderated, and the interest rate hike is also now getting confirmed that yes, interest rate is going to now stay on the up cycle. And these are some of the things I think is still playing its role on the market in terms of driving the volatility. But having seen that, market always goes through some ups and downs. Having seen a significant rise, this is my own belief is it's part and parcel of the broad market trajectory.
So, Bala, how well do you feel domestic factors are placed at the moment? Because there were also some fears on growth in terms of what we took away from the RBI's latest commentary. So earlier, while the narrative was that even if globally things look rocky, domestically we're continuing to see robust interest in equities and growth. If growth starts to look rocky back home, what happens next?
So I think from an India point of view, we can probably say to some extent, we stand out a little different from the global economy. There is no question, because of one, we're also a consumer of commodities. We're also producers of commodities. And second is the efforts that the government has been putting in terms of improving the overall GST collections and tax collections have been on the uptake. The rural economy continues to do very well. And then the government spending in terms of replacing the private sector capex, which has been missing for quite some time. The government of India has been the single largest spender, both in building the infrastructure across the country, jointly with the state government. Therefore, that is actually driving the overall expectation of the growth. That's if you look at, I think most of the consumption of various produce in the country has been on track, except on automobiles. I would say there is a marginal dip. But at the same time, from a domestic point of view, the rural economy, I think probably would be the major driver as next round of growth, and that not got anywhere impacted from the growth expectation to moderated quite substantially. Therefore, from India, I think probably would become the biggest beneficiary. The moment we see some progress happens on the positive side on the Ukraine and Russia war, and therefore actually lead to a significant drop in the prices of commodities. And combined with that, what we are seeing in China has been going through a tough time. Even the pandemic itself, they are still not come out of it, and then come back on growth path is going to take some time. That has been the case, and India would emerge as a strong winner in the whole process after say 2-3 months. I think that 1 or 2 months, I think, are directly linked to the global market sentiment. I think our equity market continues to remain volatile. But I think as we progress clearly, I think India could stand out differently from the rest of the world.
Interesting. So you're saying we're well placed in the overall scheme of things. In terms of flows, Bala, I have to just touch upon that before I get into specific pockets of the market and where you see opportunity. In terms of flows, what do you feel is going to be, or where do you feel we're going to see strongest momentum? Are we still seeing the China Plus advantage coming in with money moving into India with the rate hike, the anticipated rate hike in the US? How's that going to impact things?
Yeah, I think I'll put it in two parts.
Yeah.
I think the flows into the equity market from domestic investors will continue to remain robust.
Okay.
For one simple reason that there is no much of credit demand that is coming from the banking system point of view. I think RBI continues to maintain reasonably good liquidity situation in the system, in the whole banking systems. At the same time, the absence of credit offtake a big time happening. The banks continue to remain somewhat the believer of keeping the low interest rate, especially on deposit offering. Therefore, the investors' point of view, I think there are not much alternatives left. Therefore, their interest towards equity market will continue to remain, given the fact they are coming for the long term. As far as the overseas market concerned, I think definitely the rise in interest rates globally, especially in the US, 10-year bond is touching 2.89, and earlier about 6.5 times number of times in which the interest rate hike was supposed to come. I think as latest as last week, they have now increased 8.5 times the number of hikes could come. And potentially, assuming scenario in 2024, we expect US 10-year bond yields to be close to about 4%. So naturally, I think the flows will not come to the rest of the market. I think flows will stay within the US, and probably a time will come the bond yields become more attractive than actually even the equity market in the US. Therefore, some element of shift will happen. Therefore, expecting global flows to come to India at this point of time may not be fair.
Right.
Having said that, as I mentioned, the rationale behind money coming into India, before I just mentioned about that India probably will stand out completely different from the rest of the global economy. And that is the time I think India will start seeing some kind of fresh flows of funds in the second half of this financial year. Given the fact that India will probably will be insulated from the rest of the global market, and the currency market in India, I think it behaves much more stable rather compared to most other economies. And forex reserve that India is carrying is also pretty good. And therefore, on a holistic basis, India is managing the whole situation quite nicely. Therefore, the confidence of global investors coming to India, second half of this year, I think would be different from what you are seeing in the first half.
And just to add the element of crude prices there, Bala, you don't see that being a bigger risk. You feel that overall, like you said, because of the factors you mentioned, it's being managed, or that from here on, we might not see any dramatic increase. Would you be factoring that in?
I think oil is, I think if we go with the logic that we have been having for the last 2-3 years, the whole consumption of oil compared to the other green energies has been going down. I think green energy has been picking up everywhere.
Right.
And the availability of power situation globally is different from what you have seen in the last few years. But having said that, I think the recent price spike in prices of oil and gas, I think suddenly because of the some shortage that has come in the European countries and other countries, therefore it got elevated because of global reasons. But I think within India, I think we are self-sufficient. I think we are able to manage between the oil-led of growth. At the same time, the energy production coming from the green energy also is rising on the other side. Therefore, I think if this continues, clearly, I think the pressure that you are seeing could potentially be temporary.
Okay. Earnings this quarter were expected to be subdued somewhat because of the kind of price rise we've seen across commodities, for instance. Some have surprised on the positive side, like a TCS, but similarly within the IT pack itself, we've had disappointments as well, for instance, like an Infosys. What do you feel is going to be the takeaway from this quarter's earnings, and how much should really we be reading into it at this point? Is it too soon?
See, as I believe that, of course, quarterly results on some kind of indication of the short-term pain points and pressure that could come into every company, whether related to the currency, whether to the order book position, whether it is related to the spending of various projects, therefore have an impact. I think if you look at this structure, most of the sectors, like technology, structurally they are in a longer-term bull story. So given the fact that spending on the global market towards upgradation towards the technology and moving to the digital technology space, where I think very rapidly the growth has been coming, and everyone needs to get prepared actually the future by of increasing their spending towards IT as an element of as one of the segment of the spending, capex, you can call
Sure.
it, or we can call it the OPEX. And that is being the case, I think one should not get carried away by one quarter numbers. Of course, market is bound by short-term expectations. But otherwise, from investors' point of view, one should not get carried away by the short-term fluctuation, saying something is bad, and we have to look beyond, I think, one quarter. I think that's the same case goes with actually when companies like HDFC Bank, they come out with good result. But having said that, the banking sectors, of course, as we move forward, provisioning will be less, which of course is good, given the fact the last few years, none of the banks have actually created more non-performing assets. Therefore, I think these are some of the trend I think one has to get accepted. And given the fact the longer term, these are the sectors will remain a core integral part of every economy.
Sure. Do you see further consolidation across sectors or large companies? Bala, is that a theme that you see continuing given what we've seen, for instance, on PVR Inox, HDFC and HDFC Bank, a couple of mega mergers early this year?
I think this will be, again, my own belief is it will be an ongoing, but every 5-6 years, we do see a consolidation in every industry. And the new players coming, they create a business, they create a value for the shareholders. Once it is certain size, I think everyone has got their own struggle going beyond certain scale and size. Okay, not everybody is able to create a scale. Everybody is able to create a good business model, good profitable business model. And at the same time, they all have a struggle in terms of taking to the next level of the size and scale. And I think what you have mentioned about the PVR is more of the hunger to have actually size and scale, a larger market share that all of them need to control, and that's what's happening. My own belief is that more and more economy getting expanded, more and more players coming in, the consolidation will again be part of the ongoing exercise, but at the same time, the new players will come and create a new set of business model as well.
Talking about new players, aviation, I'm not sure whether you're tracking it, but just your expert view on the space, given the kind of announcements. We've got, of course, Tata's taking over, one flagship, but we've also got Akasa launching soon, Jet planning to get back in the works later this year, in a sector which is still not quite figured out its business model and continues to have some very heavy costs.
So I think, of course, the competition always is good for the consumer point of view. That's why every country encourages more competition to come in, keeping in mind the interest of the consumer at the center. But having said that, the more players coming in, but they don't run the business with an economic model, even if they have to sell cheap, but still don't pay attention to the money that you spend in terms of running the business and continue to remain a loss making. Beyond the point, there will be a question mark in terms of the survival of the business itself. Leave aside the sustainability, the survival itself become a question mark. Therefore, somewhere I think one has to strike between a right balance between the pricing and the cost that is incurred, at the same time being fair to the consumers. As long as every business is actually made to run in a profitable way, despite the competition being there, not to run over each other's shoulder, I think as people are able to actually build a business with a reasonably profitable business, given the fact the consumer demand in the country has been rising and the consumers are willing to pay a price even for the convenience that you provide. As long as I think one doesn't spoil the consumer mind by offering a very cheap, at the same time not focusing much on the cost structure and therefore creating return on shareholders' value. If we don't pay attention, the longer term, I think we'll probably see what we have seen in the last few years, especially on our industry. Something we can repeat it. Therefore, having experienced various ups and downs in the industry, and given the fact this industry remains one of the core integral part of the country, from a consumer point of view, from a traveler's point of view, from a passenger's point of view, even from the country perspective, I think somewhere the price semblance has to fall in place, which I believe with the Tatas coming into this field, and probably you will see that emerging as we move forward.
Okay. Bala, you said that pockets like IT, banking will continue to be mainstays of one's portfolio. But where do you see the potential for multifold returns? You talked about the rural economy, of course. What are some of the perhaps plays based on that, or other ancillary plays that you feel could really be the big surprise going forward?
I think more than the surprise, of course, surprise comes in one or two sectors. It doesn't come in all the sectors.
Sure.
And as we normally know historically that we have seen. But I think when I say the integral part of the economy, whether it is banking sector is considered as a proxy within an economy,
okay.
I think the structurally ITS sector is falling into the longer term growth story. The same way we look at FMCG companies, and given the fact they cater to the growing needs of the consumer demand in the country, especially on the consumption story, There are many companies falls in that category.
Okay.
There are many small companies who actually bring in innovation and bring in new way of doing business, reaching out to the customers in a much faster pace at lower cost and so on and so forth. There are many companies that actually does a lot of innovation. And that's why I think the companies actually focus on this innovation, focus on consumer centricity, and probably would become one of the large winners. Very difficult to actually attach this to any specific sectors, given the fact that this innovation can happen in any sectors. But having said that, I think the traditional businesses, as long as they're able to model the business completely different to the new world, including auto space or auto ancillaries, especially in foraying into the EVs, and yet become a more profitable and also become a scale player. There are many companies and existing companies who have a longer term track record. They're all actually moving into the direction. Therefore, all such companies could potentially become, I would say, the multi-bagger as we move forward.
Okay, that's really interesting. What about all this continued hype around crypto, Bala? Just want to get your take. Which side of the fence are you on when it comes to some of these new age assets?
I think interesting. I think the crypto is something. It's more of a speculative. So my own belief is, of course, market is always driven by both fundamentals and some amount of speculative bets which people do take.
Right.
And there are many speculations that happens without, of course, getting underlying value. And I would probably say at this point of time, given the fact that crypto as a currency is still not acceptable in the world, and it's still not coming from the owner of the currency, which is nothing but the central banks globally. They are the monetary authorities. They are the one who print money. And anything which comes other than the people who are responsible for printing the money, then one has to look at always such an asset class with some element of doubt. Right. But given the fact that now it's becoming more and more in making inroad, and given the fact that digital currency is also now beginning to be the part of discussion everywhere, we'll probably see actually how it actually take a shape. In this process, somebody of course will die. Somebody of course will fix a new model in place. This is something I think is not our cup of tea at this point of time.
Sure. Bala, while we have you, given the growing resonance for debt funds, I do also want to just get a take from you on the case for that and whether for, a retail investor getting into the markets, and today we have so many more investors jumping onto the bandwagon and many of those, watching the show today. Do you feel that should be a choice or a fundamental part of one's portfolio? What would be the strategy you'd leave some of our viewers with today if they're looking at investing from a longer term horizon?
So I think from a fixed income investor's point of view, there's one asset class which got developed the last few years, which actually had a greater acceptance from investors' point of view. It's the mix of equity and debt.
Okay.
This is the balance advantage fund as a category or equity savings fund as a category, which of course takes a bet on both an equity and fixed income. And given the fact the interest rates now, the 10-year bond yield is now coming close to about 7.25, assuming scenario it goes up further, definitely there will be an opportunity which a money manager will take advantage in buying those securities in the balance fund as a category, balance advantage fund or maybe other category, which is in the hybrid category. But for pure fixed income, definitely there's an opportunity which of course we do see which called which target return fund for 1 year and 2 year and 3 year. They call it the target return fund. As long as you hold the investment for the full period for which you are coming in, then naturally you'll have to live with the market volatility on interest rate movement. But at the same time, you hold it for that full 1 year period or 2 year period, you'll more or less get what is the return that is now being generated in the scheme. Because given the fact that you buy only the 3 year paper and a 3 year target return fund, you'll buy a 5 year paper and a 5 year target return fund. So that's the way I think the model works. Therefore, from investors' point of view, definitely it makes sense to look at that segment, as long as these true conservative investors do not want any other instrument other than pure fixed income securities. I think it makes sense. But having said that, I think assuming scenario in the next 4 or 5 months, we'll see some more interest rate cycles and then we'll see some more interest rate movement upward. Then naturally, fixed income could also potentially act as an alternate to an equity, which predominantly people have been saving the investment for quite some time. But having seen that, one has to also keep in mind, today the real interest rate in US is completely negative, where the 10-year bond is about 2.8, inflation about 8.5%. India is about inflation, let us take about 5.5 to 6%, 10-year bond is about 7.3. Here real interest is positive, but globally real interest is very negative. And that is being the case, especially when real interest is negative, you don't have much choice but to go and put money on equity, given the fact that equity is only one instrument which can give you a real income positive compared to the inflation that exists. So these are some of the dynamics I think one has to understand while choosing this asset class.
All right. And real return expectation, Bala, going forward this year, if it's the year of consolidation, what should be an average return that people should be happy with? I'm not going to ask you outlook or, target for the index, but, perhaps a return scenario that you feel is feasible or realistic.
Now, interestingly, about this question, of course, is always debated and discussed every year at the beginning.
Yes.
But one assumption we always make at all point of time in equity, we normally make an assumption anywhere between 12 to 14% kind of assumption one should make. But that should never be for the particular year, though we make a prediction for the particular year ranging from 10 to 14%. But we may probably end up having a negative return on particular year on some year. On some year, we'll see an exceptional high return what is in the last 2 years.
Okay.
Whenever market has given exceptional high return in excess of say 50 or 60%, the next few years market goes through a consolidation. Given the fact that no market can give beyond say 10-year period a return in excess of say the nominal GDP plus 2-3% risk premium, which in the range of about say 12 to 15% kind of return the market cannot give. If anything one gets in excess of that, one has to consider as a lucky period in which they have made the investment. Therefore, instead of making a prediction for 1 year, I think one has to actually look beyond 1 year. That's why I look at it.
All right. Bala, thank you so much for joining us on the show today. It was fantastic speaking with you and getting a sense of where we stand as well as the kind of opportunity that's ahead for Indian equities. Thank you so much once again for joining us on Business Today.
Yeah. Thank you, Aabha. Thank you.
If you like the video, do like, comment, share and subscribe.